Okay, welcome back. So we're going to be talking about current liabilities and payroll today. We're not going to get too involved in payroll, especially not with the payroll journal entries, but I do want to talk about payroll a bit. We're going to be focusing primarily on our current liabilities. Now, current liabilities, by definition, are those that are expected to be paid within a year or an operating cycle, whichever is longer. All right, so with that, some examples of current liabilities. Your most typical example and probably your biggest example of a current liability are accounts payable. Now, accounts payable, if you remember, arise from your regular trade or business. So this is money that you owe doing what you do. So back to my whole donut corporation that I've got here. If I've got a donut corporation, I'm going to owe people money. I'm going to owe people money to my suppliers, my flour supplier, my sugar supplier, my milk supplier, and so on and so forth. Okay, those are going to be accounts payable because they arise from my regular business. If I borrowed money from a bank or something like that, that is not going to be referred to as an accounts payable, but rather it's going to be classified as a notes payable. All right. Notes payable is a little bit more formal than an accounts payable is. Notes payable tends to be for a longer period of time or a stated period of time. We might say that a note is going to be for 3 months or 6 months or a year, whatever the case might be. Notes payable usually also has an interest rate associated with it. Okay, so an accounts payable is something that arises from your regular business, and notes payable is going to arise from someplace a little bit different. And we're going to get into notes payable a little bit further into this chapter. The other item I wanted to touch on is the current portion of long-term debt. What I mean by this, all right, is let's say you have a 30-year mortgage. All right, you know that it's a long-term liability because we're talking about something that's going to be paid not this year, but over the next 30 years. Well, the idea is that even if you have a 30-year mortgage and it's the first year of it, some of that money is going to be due this year. So year one is going to be due this year and is going to be classified as a current liability, whereas the other 29 years that you still have to pay will fall into that long-term liability category. Okay, now the reason it's really important to classify these appropriately is because you want to know, if you're looking at a business, what liabilities are they expected to pay within this year. So let's just say they had current liabilities of $400,000 and they had assets only of $250,000, current assets. That would be a rise for concern because clearly they don't have the money, or the short-term assets, in order to pay all of their current liabilities. All right, so this might be a company maybe that's got great buildings and great long-term assets and things like that, but if they can't meet their bills on a day-to-day basis, then that's something to be concerned with. Okay, so classifying something as a current liability is quite important because you're looking at a short-term business, short-term portion of the business and saying, okay, within the next year, are they okay to pay their bills? Will they have any problems doing so? So current liabilities is an important classification. All right. So accounts payable, we just talked about that. All right. Accounts payable tends to be a large portion in, like I said, your biggest section in your current liabilities, because that's which makes complete sense because that's the money you owe doing whatever your core business is. So just some examples. If you've got like the Gap or even Chevron, Texaco, or Rite Aid, the largest portion of their accounts payable, their largest portion of their total current liabilities tends to be accounts payable. Okay, just talked about that. Okay, long-term liabilities. Long-term liabilities are those that you're not going to pay within a year. So you saw that notes payable, I just want to mention something. You saw that notes payable is listed as a short-term liability or current liability. Well, that's only if it is a short-term or current liability note. You could have a note that's due in 3 years. And if the note is due in 3 years, then it's going to go into the long-term liability category. So it's all about timing on a note as to how long the period of time is that you're going to, when you're expected to pay it back, as to where you classify it. Now let's look at a journal entry for a note, since we are talking about them. I don't think we really need to spend too much time on accounts payable because, like I said, accounts payable is something you've been dealing with since Chapter 2. All right, if you buy something, you have an accounts payable. If you have utilities expense, say you've got your utilities bill in the mail, then you have a debit to utilities expense, credit to utilities payable. All these things are typical short-term payables, and you've been dealing with them for chapters and chapters at this point. But let's focus on notes payable a little bit here. And let's look at a short-term notes payable. Let's say a firm issues a 90-day 12% note for $1,000, dated August 1st, 2008, to Murray Company for a $1,000 overdue account. So what we're looking at here is we had an account payable. We owed somebody money, and we couldn't pay it, let's say. So we pick up the phone and we say, hey, Murray Company, can we give you a note instead and not pay you within the 30 days, which was our original agreement? I'm making up that number, but can we not pay you within the 30 days, and can we pay you in 90 days, and I'll pay you a little bit of interest while we're at it? And Murray Company maybe values our business, and they say, you know what, that's fine. Pay us in 90 days, give us 12% interest on it. So what we're doing here is we're basically shifting an accounts payable, that amount to be out of the accounts payable account and into the notes payable account. What that looks like from a T account perspective is, alright, so this is what the setup of those accounts look like. You would have a credit balance in the accounts payable $1,000. So we owed somebody $1,000 and we decided, you know what, we can't pay you, we're going to pay you in 90 days, and we're going to pay you 12% interest rate. So what we're going to do is we're going to shift the $1,000 out of accounts payable and put it into the notes payable category. Okay, so what we're going to do is we're going to actually debit accounts payable for $1,000, and we are going to credit notes payable for $1,000. We're just really moving it out of one account and putting it in another. All right, so my sense of completion needs to show the zero. And this is where we are. And we have $1,000 here into notes payable. Okay, moving right along. So let's calculate what happens as we have to pay out on this note. We have to pay out interest. What it was is it was a $1,000 note, principal times interest times time. Like I said, that is always your calculation for interest. I don't care what class you're in or anything like that. This is always your calculation. So what it was is it had been a $1,000 note, there's your principal, times an interest rate of 12%, which is a crazily high interest rate, and times time. We were talking about 90 days. You can go with 90 over 360. I prefer to think of 90 days as 3 months, so you can say 3/12 there as well. So what we're looking at here is we're looking at interest of $30 we're going to have to pay on this note. Okay, so when we actually do pay out the note, we don't have to pay just $1,000, we have to pay out $1,030. So our journal entry is going to look like this when we actually go to pay out the note. You can have a debit to notes payable because you're paying it off of $1,000. That's going to zero this out up here. I'm not going to click on there, or I'm going to ruin my setup here. You're going to have a credit to cash of $1,030 because, like I said, we're not just paying $1,000, we're paying $1,030. The piece in here that's missing to make this balance is going to be a debit to interest expense in the amount of $30. Okay, so that's what your journal entry is going to look like when you actually go to pay off this note. And we're clearing out our notes payable with this entry, and again, my sense of completeness says I need to make this a zero. Alright. Not an O, a zero. There you go. Okay, so that's what your journal entries generally look like, the simple entries for notes payable.